Hoonigan went bankrupt. What does that mean? That sounds scary. Oh my gosh. I've seen a lot of information out there that just isn't accurate, and I have a unique role. I straddle both the automotive world and the private equity world. I am a Formula Drift Pro Spec driver, and I have been a racer most of my life. I was involved in the industry since age 14 as a videographer, became a driver at age 16, got my Formula Drift license in 2020, and have competed for 4 years. So I have dealt with a lot of different companies in this space, including big ones and small ones and everything in between. Now, on the finance side of things, I started my career as a consumer investment banker in New York with a firm called Stephens Inc. And I continued my career by switching to private equity, but I specialize in defense and government services businesses, so completely outside of the automotive world. With that being said, from a structural perspective, from an understanding of how finance works, that is pretty much all the same behind every single industry. So I want to clarify and clear up a lot of things that are being said because they just aren't true and are not capturing the full perspective. All right, so let's just start out with explaining what Hoonigan actually is. It is not just the content piece that you know and love and have seen grown from Ken Block and etc. So Hoonigan was actually purchased several acquisitions into the platform investment from Clearlake, which originally was Wheel Pros, that they did that deal back in 2018. So one common private equity strategy is a roll-up strategy. It's the idea, very simply put, is to buy several businesses, package them together as one, integrate them, meaning back office and everything is all in one place. And then a big part of the strategy is to rebrand as a new name. And so in this case, Wheel Pros bought Throttle, it brought a bunch of different things, and then Hoonigan was one of those brands, arguably the strongest brand. So what did they do? They rebranded the entire platform as Hoonigan. So when you're talking about Hoonigan, you have to consider that it's really not just Hoonigan. There are a bunch of other pieces of the puzzle that make up the Hoonigan platform. All right, next, let's talk about what bankruptcy means. So what bankruptcy means for your purposes, I'm just going to talk about two different ones and try to explain them very simply. So you have Chapter 11 and Chapter 7. Chapter 11, which is what is going on now, means reorganize, come up with a plan to eliminate debt, and start over, basically, and continue to operate the business. And plenty of companies can come out of Chapter 11 and just go back and be normal, basically. Holly is actually a great example of a company that was once in bankruptcy and then emerged out of it and then sold several times, and now it is a publicly traded company. So Chapter 7 is what you're probably more familiar with when you say bankruptcy, which is complete liquidation, just fire sale, everything has got to go. So to clarify, Hoonigan filed Chapter 11, which is reorganization, and simply put, all of the equity holders, meaning the owners of the business, meaning Clearlake, they got wiped out. Asses handed to them, but also all the rollover equity from all the businesses they bought. If you were an existing owner of a business, you sold to Wheel Pros, and you retained a little piece of ownership, well, guess what? That's gone too. Sucks, really sucks, but that's the reality. All of those equity owners are now done. They own nothing, they have no control, they are out. And so what does that mean? That means the people that lent them money, and it gets really complicated on purpose to confuse you, but let's just simplify. The most important lenders, the first lien lenders, now own the business, and of those lenders, the largest is a company called Strategic Value Partners. And what are they? I honestly don't know a lot, but from looking at their website for 5 minutes, you can tell that they are a distressed investor. They specialize in investing in these types of deals because they know they can basically lend this company money at a sizable return rate. And then if all else fails, they get to take over the business, and they're loan to own. Scary people to deal with, complete sharks, and not somebody that you really want to be dealing with, but you're Wheel Pros and you kind of got yourself into a bind. Nobody else, is willing to lend you money, so you turn to the mob, and the mob's gonna get you. So, all right, next, what actually led to these Chapter 11 filings? So the funny thing is, there is a 120-page document that tells you exactly what led to the filings. It has nothing to do with content. That's the best part, right? Business challenges. So they had macroeconomic shocks. Basically, a lot of these deals that were done by Wheel Pros and Hoonigan in terms of buying things happened during COVID. Now, during COVID in the automotive industry, people had never, ever bought stuff like they did during the pandemic. Nothing else to do. I'm just going to keep buying car parts. So that sent a huge shock into the system. Companies were selling out of everything they had, but then they were not able to replenish inventory, so they ramped up production, and they had a lot of supply chain issues, like things were way more expensive and all this other stuff. So basically earnings shot up artificially, because as we know, once COVID returned back to normal, people stopped buying stuff as much as they were during that time. And so if you bought a business off peak earnings and then it falls, and you were using debt to fund that business that now can't repay its debts because the earnings fell, I think you can see the problem here. So those were supply pressure issues, macroeconomic shocks, corporate organization and internal controls. So meaning when they bought a bunch of different businesses, trying to integrate them, it turns out is actually really hard, and they didn't have appropriate controls. They probably had inventory issues. It's not super clear what exactly happened. Onshoring challenges. So in 2018 and 2020, the company, in an effort to increase the speed at which it could bring its products to market and to reduce reliance on overseas manufacturing, they purchased 2 facilities in York, South Carolina, and Auburn, Alabama, respectively. So they purchased these facilities for $12 million, and they invested additional capital to refit and restart these operations. And ultimately, the company was forced to divest a significant portion of its manufacturing facilities in the York location in 2021 and close the plant in Auburn entirely in 2023. So you basically made a $12 million plus investment, and then it went away. And I think part of that had to do with trying to, again, speed up production, try to fill that demand that happened during COVID. Oh crap, like that thing went away, and now you're stuck with these facilities that just are losing money. So all of these things that they just laid out, those 4 things, led to a banner sales year in the company. So during the pandemic in 2022, where they achieved $1.5 billion in revenue, but then the revenue fell to approximately $1.34 billion in 2023. So you basically lost almost $200 million in revenue in 1 year. That's insane. And then between the fiscal years 2021 and 2022, the company's adjusted EBITDA, oh, scary finance word. Okay, so what does that mean? Earnings before interest, taxes, depreciation, amortization, adjusted. So adjusted, funny word, it means add backs, which are honestly made up. So they're expenses the company realized, but I can argue were one time, only, extraordinary, never going to happen again. Long story. But whole point of that is it is a proxy for cash flow, and it is what you are judged on when you're selling the business or when you're raising debt capital. Anyway, their adjusted EBITDA dropped by $152 million. And in fiscal year 2023, it dropped another $23 million. Holy crap. So you mean your profitability declined more than $175 million in 2 years. That's awful. That is terrible. All of this ended up with $1.2 billion worth of debt. So if you think about that number, you're probably like, oh my gosh, that sounds huge. But if you have the earnings to support it, then it's really not that scary. The lenders lend you money based off of ratios, right? And if you can meet those ratios, then they are comfortable with lending you money. So I'm going to talk about 2 of them. All right, the first one I think is a little bit easier to understand, and that's just your total leverage ratio. So that means your debt divided by your adjusted EBITDA. And so if your total debt divided by adjusted EBITDA equals around 3 to 4 times, that's not so bad. So let's look at what Hoonigan's current debt ratio is. In the bankruptcy filing, Hoonigan has listed out its 2024 expected adjusted EBITDA, and it's $111 million. Okay, so they have $1.2 billion worth of debt, right? And we're just going to use round numbers, but $1.2 billion divided by 111 million equals 10.8 times. Holy crap, that is a lot. That is so much. They do not have the ability to pay back the debt. I've typically levered businesses anywhere from 2 3/4 times to 4, maybe 4.5. Now, granted, I only work with businesses that are in the range of sub $10 million to $20 million of adjusted EBITDA, because at that point it just makes more sense to exit the business. But over 5 times is very risky. And the other leverage ratio to focus on is the debt service coverage. It basically implies, can you pay back, can you service your debt? Meaning, can you pay the interest, can you pay the principal? And usually you want that ratio to be the banks want the ratio to be over 1, meaning you 100% can guarantee you can pay your debt. Kind of makes sense. But then banks actually like to have a little bit of a cushion, and some are willing to take less of a cushion, some really want a lot. It's really dependent upon what negotiations you're doing, but I've seen them range from 1.1 at the most aggressive to 1.25, maybe even 1.3 or 1.5 as the years go on in the loan. So anyway, those are the two ratios that dictate how much debt is actually a lot, because $1.2 billion could be not a lot if the company had $1 billion worth of earnings that it could use against those ratios that I was just talking about. All right, so overall, what does this mean for the consumer? So Chapter 11 is not a liquidation, it means a reorganization. And what does that mean? It means the balance sheet gets reset. So all of that existing $1.2 billion goes away, and the lenders have agreed to basically, instead of taking their $1.2 billion, they are now going to take over control of the business, and they're kicking out all of the old equity owners. And what's going to happen next? Management team may or may not get fired, and the business will continue operating. And if all else goes well, then maybe they'll emerge out of this successfully. And if not, then maybe we go back to Chapter 7, bankruptcy and liquidation, and then game over. That's it. As a lot of others have already pointed out, there's already been a lot of mistakes on the Hoonigan side of basically getting rid of the people that made Hoonigan. Obviously, RIP, Ken Block, but there was a whole management team there and a bunch of content creators that were there that are now gone. And I think this is where private equity fails to realize that they actually bought a people business. Because these same geniuses that are used to investing in water valve businesses think that they can apply the same logic to an automotive brand, which is an enthusiast brand, which is not a water valve control business. And that's why generalists like Clear Lake get their asses handed to them when they try to mess with industries that they don't know anything about. I personally am a very specific, very focused investor in defense and government services. I love that industry from an investing standpoint because there's a very clear value proposition to building good businesses and working with founders to help them, enable them to transform from a small to mid-sized business. So not all private equity is made equal. Generalists in this day and age, there's no place for them. They get their asses handed to them all the time because they try to fit investments in industries they don't know anything about into a box that they're familiar with. And when you do that, it's not one box fits all, because something that works in the tech world is not going to work in the finance world, is not going to work in the water valve control world or whatever that is. But that's what Clear Lake invests in. And if you're not an industry specialist in this day and age, then you don't know what you're doing, and you only know how to be a financial engineer or Wall Street banker guy. And guess what? That era is over. That was over so long ago. That worked in the 80s, maybe even the 90s, maybe even the early 2000s, but it's 2024, and you're very quickly seeing generalist firms lose their shirt on deals like this where they don't understand how the cause and effect relationships work with management and content creators and overall value proposition. So hopefully this was interesting. I'm happy to talk about finance more because that is the other side of me that you may not see if you only look at my drifting stuff. All right, well, until then, have a good one.